Let's turn to the Fed speak. Continuing today with Governor Waller, set to deliver remarks at the Economic Club of New York. On Friday, you'll hear from the San Francisco Fed President Mary Daly, speaking ahead of Chair Powell himself. Their remarks coming after the Fed's preferred inflation gauge, PCE, is due out 8:30 Eastern Time on Friday. Bloomberg Economics expecting core PCE to rise the most since September, backing the Fed's patience on rate cuts. I'm pleased to say that we're blessed with the presence of the former Fed Vice Chair, Richard Clarida. Rich, it's good to see you.
And I'm blessed to be here.
Oh. Thank you very much. I've been singing your praises for the last week because I was thinking back to the secular outlook from PIMCO in the middle of last year, where you and the team wrote down this Fed will accept 2 point something. Can you describe what you were looking for back then, what you saw and whether it's starting to come your way?
Well, John, I think it has played out. Look, I think Chair Powell and the committee deserves enormous credit. Inflation got up to 5.5% or 6%, maybe 10 on headline. It's now running in the twos. Our view then was 2 point something would be the point at which the Powell Fed would start to pivot towards easing. I think they think they're done. I think they're signaling that they're going to be cutting starting this year. I think it's important to remember the goal is to get to 2%, but they're going to start cutting before they get to 2 based upon their view that financial conditions are tight. So we'll see how it plays out. But I think so far that's played out like we thought.
A phrase you've used is opportunistic disinflation. Can you help me explain the difference between what you see and maybe what others see when they start to say things like, and I was talking about it on this program, a higher tolerance for inflation? What's the difference?
I don't think John, I don't think there's the tolerance. Opportunistic inflation actually is something that folks thought the Greenspan Fed did 30 plus years ago. That as you tighten policy, you get inflation close to where you want it, but for that last mile, you just wait till the next recession to get it done. And that could well be what we end up in this cycle. That is, the rate cuts will start before you get to the long run goal of 2%. And at some point, there'll be a downturn. Inflation can fall further then. The tricky thing is, of course, the Fed wants to avoid the downturn in the first place, which means at minimum, Chair Powell will have some communication challenges ahead, I think.
Well, there's a lot to unpack there. Just let's start on the first issue, which is something that Andrew Hollenhorst was talking about earlier this week, that essentially you cannot get down to 2% without a recession. Do you agree?
Well, I think historically that's what you would say. But look, the progress has been remarkable. You mentioned Governor Waller, big fan of Chris's, worked with him. You know, Chris has been making the point you can get back to 2% without a lot of unemployment if vacancies are cut. So I don't want to say that you can't get there, but it could be a heavy lift, yeah.
Well, and the other part of what you said is really important. The Fed doesn't seem to want that weakness. And they even said that they would cut rates in response to a weakening labor market.
I noticed that, yeah.
What does this mean for the longer term inflation rate? Does it mean that 2 point something is the floor and kind of we could see sort of bouts of volatility in inflation in the upcoming years?
I think that is a risk case. I think the progress on disinflation is remarkable, but inflation's still above where they want it to be, and there's some evidence that it may be more sticky and stubborn than folks were thinking. Again, I'll let the data speak for itself. I hope the Powell Fed really is data dependent. I think they need to be open to the possibility that inflation is sticky, and I think that changes their communication and the rate path.
Can you help us understand the inconsistency that we struggled with last week and again on the program this morning?
Yeah.
We caught up with Bruce Kassman at JP Morgan, who was brilliant, and acknowledged the difficulty in explaining the following. When the Fed is asked if we're sufficiently restrictive, Chairman Powell will often speak and point to the labour market, then simultaneously embrace and confirm that a lot of the improvement came from the supply side. Now, I'm trying to understand whether you can really point to the labour market as a sign you're sufficiently restrictive and also acknowledge that a lot of the improvements come from the supply side. Can you do those two things at once?
You can. I think, look, there has been improvement in the labor market. Wage inflation has stepped down from 5.5% down to around 4%, but that's still a little bit hot compared to where they want to get. But the chair is right. There's been important supply side benefits, in particular labor supply. Productivity's also picked up. I actually think, John, if I could, I think maybe a little bit more of a disconnect is on the financial conditions predicate itself. If you just look narrowly at the federal funds rate, it's well above inflation. That looks very tight historically. But of course, very few people, including banks, borrow at the federal funds rate. If you look at mortgage rates and you look at other things, they've come down and credit spreads are tight. Bloomberg financial conditions indexes, including Bloomberg's, are easing. And so he got that question last week about financial conditions, and he says, we think they're tight. Well, they could be, but they're certainly easier than they were in November. So,
what do you think he's pointing to when he says we think they're tight? What is he pointing to?
Well, absolute borrowing costs. If you want to get a car loan, if you want to get a mortgage rate, so traditional indicators of the cost of borrowing are elevated, but obviously other indicators are moving in the other direction. So as usual with the data, it's probably a mixed picture.
Do you think that it's clear that it is truly a sufficiently restrictive rate currently at the Federal Reserve?
That would be my base case, but there is a risk that it's not. And I think importantly, the focus on the baseline, of course, is reinsuring. We want to know what's going to happen. But I think there is a risk management case here where it may not be restrictive enough. I think the Fed's view, I don't think people care what I think. I think the Fed's view is if inflation's stickier and more stubborn than they want, they'll just keep rates at the current level longer, or they'll reduce the pace of rate cuts. I don't really think the Powell Fed is thinking about hiking anymore right now. I think they think they're done.
You said if the Fed really is data dependent, and I don't think you're necessarily casting doubt on whether they look at the data, but what data matters most if what we're looking at right now is inflation data that is coming in hotter, and frankly, goods disinflation that seems to have ended?
Certainly the January and February data, if the PCE comes in, that would be the reason. There is some evidence, and I think the chair is correct, of seasonality. That's always tricky. And in recent years, most of the bad news in inflation has been in the first 4 or 5 months. So I don't think we want to remove that possibility. I just think that a sticky inflation scenario is maybe not a baseline, but it's a very realistic case. And I think investors and people looking at the economy need to start thinking about it.
How do you perceive the balance of risks? Holding too long or cutting too soon? What is the bigger risk for you?
Well, I'm no longer there, so it probably doesn't matter. I think given that the last 3 years, inflation has substantially overshot the target. Look, I was a charter member of Team Transitory. It's looking better now than it did a year ago. But I think there is path dependence and history dependence in monetary policy. And so I think the risk management I would be doing if I were there would say there is a real, we want to avoid having inflation shoot up again and having the credibility challenge. So I would be leaning more in a hawkish balance of risk mode than just hugging the baseline right now.
To put sort of a bow on that point, if you think about how much more investors have to consider the idea of sticky inflation and Fed officials themselves, can you give us a sense of how much that possibility has increased, in your view, in the past month or two based on the loosening of financial conditions and, frankly, the Fed's response to it?
It has increased, certainly. Look, we got 5 out of 6 months of really, really good, surprisingly good inflation data, and for good reasons, both supply and demand. Where in some ways, I think there's actually now, compared to where we were maybe in January, a better alignment between markets and the Fed, in the sense that, after the December meeting, the markets had priced in 6 or 7 cuts, which was a disconnect with what I thought the Powell Fed would deliver. So on that end, I don't think there's too much of a disconnect. Now, I think markets understand. They think they're done. The margin that they're going to play with is when to cut and how much to cut, but not to hike. So I don't think there's that much of a disconnect right now.
One final question. Can we do the show again in Newport Beach, California? Can we do that in June?
Excuse me? Well, it's above my pay grade, but and I'll treat you to a burger like I did. Actually, you treated me, or no one treated each other. So.
No, I think we treated each other.
We treated each other.
That was it. I think sort of Manny and Mike exchanged cards or something like that. Rich, it's good to see you. Thank you, sir. Thank you very much. The former Fed Vice Chair, Richard Clarida.